This week, we're going to focus on crypto lending, yield. We've got Justin McMahon, CFO, Chief Financial Officer for Abra, Lisa Lee, Chief Risk Officer. Welcome to you both. Thanks for joining us on Money Talks.
Thanks for having us, Bill.
Great to see you. Let's dive right in. Why don't you? I would love to just have you guys introduce yourselves, and because a lot of folks that particularly on the retail side, if they're consumer investors, aren't really familiar with what goes on behind the curtains at a company like Abra. So it would be great, I think, if you could just introduce yourselves and explain what you've been doing the last few years and how that relates to what you're doing now at Abra.
I definitely am a traditional convert. So I came from the traditional space, spent about 5 or 6 years on the market making side, running operations and finance at various firms. And then prior to that, I was at Morgan Stanley for a number of years in the more traditional prime brokerage space. So went down the crypto rabbit hole about 5 years ago and haven't come back. So.
Awesome. Yeah, you joined Abra at a super interesting time, amazing inflection right around the time you joined. So you've seen quite the ride. And then, of course, this week with all the crazy press that some of our peers in space have been getting, it's crazy. So Justin, I'm gonna bring up a slide here that basically shows how traditional kind of institutional lending works and I think it's no different in what you grew up with in the prime space versus what you see at Abra, right? So talk about the prime model in general. Just give us like a quick overview of how that works.
Sure. I mean, anyone who's kind of been in the traditional space on the broker-dealer side or on the alternative side, hedge funds, kind of understands that obviously, prime brokerage and prime kind of works like a traditional bank. It's not really different other than, you're talking about large institutions, right? So deposits come in, collateral comes in, money goes out from a financing perspective. And that's kind of very basic, high level how, prime brokers and banks in general, make money. So crypto's no different. A lot of the ways that traditional prime brokers and traditional banks look to drive yield and look to make interest grow both for themselves and for clients exists on the digital and the crypto side. There's obviously a lot of nuances that go on within the crypto space just because of its emerging nature and it's still growing. But a lot of the kind of core pieces of that structure, exist for us as well.
Yep, that makes sense. Okay, so let's dive into for a moment some of the risks associated and how risk management in traditional lending works, and then I want to talk about DeFi because basically, if you're holding assets in Abra Earn, you're earning via a combination of mostly traditional lending and then a small amount of DeFi, and they have different but somewhat related risks. So we talk about credit risk, we talk about market risk, we talk about liquidity risk. Why don't you highlight like one or two of the things that you think matter most, and maybe I'll fill in some blanks, but I would love to have everyone hear your perspective on that risk management and maybe even how Abra might be a little bit different.
Sure. Yeah. I mean, it's kind of like trying to pick your favorite kid. I think they're all important. But, I think in markets like we're experiencing right now, high volatility, rumor driven, I think liquidity is obviously a really key piece that you have to stay very, very focused on. And I think, another focus that we definitely have is counterparty risk, credit risk. Markets are going to be markets. We can't control what happens with BTC price, but what we can control is who we're facing and the liquidity that we have, on our balance sheet. So, I think in these markets, you try and control what you can because you can't control everything. And so I think for us, liquidity, credit risk, counterparty risk are very key. And then, obviously duration risk, and concentration are always, things that you're managing regardless of market conditions. They obviously, become a lot more sensitive to them in high vol markets. But, those are things we look at as well every day, every minute in markets like this.
And just to put it in context, right? I mean, if you look at the terms of service for Abra Earn, you have 1 to 7 day, basically up to 7 day access, meaning it should never take longer than 7. But I've done several deposits and withdrawals. And by the way, the team doesn't even know who it is when a withdrawal is being processed. So I don't get any special treatment. I've never had a withdrawal take more than like 2 to 3 days. Most are processed in a day if they're in small amounts, just given the reserves. So that duration risk basically says, hey, we can't have loans that we can't call within 7 days on average, because otherwise we can't process everyone's withdrawal. Now, most of our customers have been holding for a very, very long time. So holding funds with a 7 day duration risk is a super conservative approach. And banks wouldn't do that, by the way. Banks would actually do something which was much less conservative in order to optimize profits, right?
Correct.
Yeah.
Sorry, go ahead, Bill. Finish.
No, as you say, and then on the concentration side, it's just common sense. You don't want to have, all of your proverbial eggs in one basket, because look, the banks have loans that go south every single day. Everybody has losses in the lending space every single day. The most important thing here is to generate returns without subsidizing them at large scale, including a small amount of losses, right? It's not to say even though we've never had to recognize a loss yet at Abra, at some point it'll probably happen, but it needs to happen in a way where all of these risk management processes don't change what I just said.
Yeah, no, I couldn't agree more. I mean, listen, if this was zero risk, it'd be zero rates, right? I mean, there's a reason why you have rates, and it's a measure of risk to a certain extent, right? So, but we're also not talking about 20-25% rates, right, where the risk would be commensurate with that, right? So we have to, I think we take a very serious view into managing not only customer capital, obviously investor capital as well. And, we have a fiduciary responsibility for that, right? And so I think we take that very seriously. And I think, we talk about this internally, but, I think it's probably good for folks outside our four walls to kind of understand this, is that, there's a lot of stuff, crypto's great and it's revolutionizing the world, and we all love that. And that's why we're here. There's a lot of core things that exist in the traditional space that translate very, very well to the digital and crypto space, and risk is one of them. And so I think if you think about a lot of the aspects of how, a JP Morgan or Goldman Sachs or, my old firm Morgan Stanley would manage risk, that is how we think about risk. And I think, the business or the market is not as mature as a traditional space. So I think there are pockets of the business that don't approach it that way. And that's just the nature of, the evolution of the market. But we've tried to take that, very seriously. So,
yeah. Impression is that a lot of these, independent of the Luna stuff, which was like kind of its own thing, and there were other firms that had large exposure to Anchor and Luna. And again, that to me, we'll get into DeFi in a minute, but it also falls under the concentration risk issue where, if it seems too good to be true and you absolutely have to go in, maybe go small. I don't know, but we're hearing more and more, and it's kind of I hate to say it, but it's kind of a function of laziness. Meaning it is very easy when something is super attractive to say, hey, that could be my personal bank account, and shove all of your money into something like Anchor that's returning 25%, which is probably too good to be true at scale. And if you're lucky enough to be the first one to get your money out when the shit hits the proverbial fan, great. But not everybody was that lucky, and so I think there's a big lesson there. I don't know if Lisa's rejoining. Lisa, just shout out if you're online. Oh, she is there.
Right, so I am back.
Lisa, we've been going through kind of the the tried and true elements of sound risk management practice, just in a broad sense, but also at Abra. And I
Yeah.
know that you have a lot of policies that you oversee, and we also have kind of we have this very rigid risk committee process. And give us like a quick few 30 seconds on what the process. If I want to borrow from Abra, right? And what am I thinking is the process to actually even be considered as an institutional borrower?
Sure. I mean, so first of all, I would say Abra, right? You don't just wake up one day and say we'll focus on risk. This risk first culture has always been in place at Abra, and starting at the very top of the organization, and really well appreciated at every layer of the firm and every function. So this is so crucial, in a time like this. And, I think our overall approach, right, is very prudent, proactive risk management. So in terms of credit, right, we look for top tier, high quality counterparties. We look at various, metrics such as size, leverage, liquidity, revenue stream, but also, diversification is important, right? We need to look for a diversified client base, and ideally, right, clients that are, market neutral or non-directional. In fact, the vast majority of our clients, right, they tend to do better in times of high volatility. So, those are some of the things that we focus on.
Yep. That makes a lot of sense. Okay, so I want to segue into DeFi. Now, collateralized lending in the traditional kind of prime broker or now crypto sense is very straightforward, right? It's no different than maybe a HELOC on a house to a certain degree, right? You can borrow a certain percentage against the equity, and you get first in line. And if stuff goes south, in theory, I could force you to sell the home. And so no different here with the crypto collateral. DeFi is a little bit different. Somebody who's lending money into a DeFi protocol is actually doing this on a kind of an automated basis, meaning if you're lending money into or generating interest on digital assets, stable coins, Bitcoin or Ethereum, it's basically via an automated smart contract model. And then there are basically an entry and kind of exit costs for getting into and out of these positions. And I'm not expecting all of you to be experts on how DeFi-based yield works. It's part of the problem, by the way, with DeFi is if you look at what Anchor is doing or was doing and a lot of these other DeFi opportunities, people are connecting MetaMask to a web browser, barely understanding what connecting MetaMask to a web browser even means, and then basically connecting their Ethereum and USDC or Tether positions to these liquidity pools, also without understanding what I just said. And so it just compounds the risk because individual consumers are doing things that they don't understand. So now at Abra, we will use a historically a relatively small amount of DeFi. It's ranged anywhere from 5 to 15% of the assets at any given time. I think now it might even be lower. But what it takes, and I'll go to the next slide here, from a risk management perspective, to get through the gates at a company like Abra is non-trivial. So Justin, maybe start with you. We've seen a lot of these DeFi opportunities at Abra, and we've said no to most of them historically. In some cases, even ones where we wanted to say yes, by the time we finished our testing, our perspective on the opportunity had changed because it takes so long to get through our process. Why don't you just talk to what it means as a CeFi company to leverage DeFi for yield?
Yeah, I mean, listen, I think it's like any investment decision, right? You kind of have to make sure that you're a little bit skeptical going in. And to your point, there's a reason why things are 15, 16, 20% rates sometimes. Doesn't mean you can't manage that risk, but it means that you have to be really, really clear what the risk is. And so I think, when we think about DeFi, we take a very, very deep approach to how we look at the risk, right? So we don't just look at the top layer rate and say, well, it's really attractive, and we're going to go in very, very small, and if it doesn't work out, great, right? Even in small size, we want to be sure that we understand the risks, that the returns make sense versus the risks, and that we really kind of beat up all the different dominoes that can fall when it comes to DeFi. Because DeFi to me is very similar to, in the traditional space, futures and options, right? You really shouldn't be trading futures and options if you don't know what you're doing, right? Because it all looks good until it goes sideways.
Right.
And when it goes sideways, it tends to go sideways pretty quickly and in size. So, DeFi is an area that if you don't know how to play in it, you really shouldn't be in it, to your point. And so I think we feel like we've built the right team to be able to take the right risk return on that space. But to your point, it's not a major part of our book. And, I think at some point as it matures and becomes a lot more transparent and easier to manage, that, it'll grow in size like any part of our book. But I think for now, we take a very kind of prudent and, rightly skeptical approach to it. And we find the right deals that make sense for us. So.
Yeah. So Lisa, to kind of go one layer deeper there, we've been pretty successful in the small amount of DeFi we've done, but yet we've chosen not to expand it for all the reasons that Justin just described. Talk about specifically one or two of the things that are essential to manage in order to generate yield on DeFi responsibly in a model like Abra's.
Sure. I mean, first, right, we focus on battle-tested protocols and strategies. We, like Justin said, we identify, risks that are idiosyncratic to the blockchain or blockchains and the smart contract. And, we do a very thorough risk analysis on all these components that you see in front of you. So basically, without going into too much detail, right, each finding in our review, right, we would deem it either satisfactory, requires monitoring, or it's an area of concern. So when it's an area of concern, before we do anything else, before we move further, we will look at the specific areas and we will conduct protocol specific analysis to address those concerns, and to determine, are they how serious are they, does it prevent us from deploying? But I think in addition to that, right, the ongoing monitoring of these strategies, such as the pool concentration, depth, slippage, that's also just ongoing due diligence, right? We practice in our credit lending book, and we practice it here as well. But I think another part that's helped us, in these recent events on the DeFi side is that, we have contingency planning in place. We will anticipate, plan out the closeout strategies, the channels, the costs, and so when that time comes, right, we'll be ready. And going back to policies and procedures, right, we put in place a very clearly stated escalation procedures that will ensure prompt communication when an incident happens, and to all the decision makers.
Yeah, I think that's just, if I can add a little bit to what Lisa said, I think that's one of the things that I think we do really well here is we don't assume markets are always going to go up, and we don't assume that we're always going to be in a good, profitable space. And so, it's that kind of embedded skepticism that, when things start to turn a little bit, we challenge it, right? Like we don't assume it's going to kind of go back up immediately. And so to Lisa's point, that communication between risk, trading, and credit, exists daily, live, and it is critical to being able to react quickly, because one of the big differences between DeFi and traditional is the speed at which things move, right? Mm-hmm. So in a normal kind of traditional space, you might have, if you're lucky, hours or days to kind of react to market volatility or market actions or rumors. in the crypto space, it's an hour, right? Or
Right.
minutes, right? And so that communication channel, those communication channels and that is critical. It has come up multiple times for us in
Yep.
the last few weeks and months. And it's really, I think, an underappreciated part of risk management. So
Yeah, for sure. And I hear and realize over and over again, and for us, maybe we forget about it a little bit because we're just used to being kind of overworked and it's a 24/7 space. If you came from the stock or equities version of this world, it's a lot easier to some degree because the stock markets are closed more than they're open. Our world is open 24/7. And so it's really essential that we have the team, the tools, the automated systems, whatever is necessary to ensure safety and soundness, given that we're talking about a 24/7 market.
yeah, I have a very good friend who is a senior trader on the swap desk at a very large firm, and he always makes fun of me because he's done it 4 and he starts at 7, and that's it. So that's not us.
Yeah.
And that's part of the cost, so to speak, of being in an exciting space like this. But you have to be constantly looking at the market, and you have to be constantly challenging what you're seeing. So
Yeah, not all of the Abra clients actually open email or are subscribed to our email. I'll show you all while we're talking this email that we sent out. And by the way, you should really get on our mailing list because we actually are pretty good at not spamming people and making it important. And hopefully you can see on your screen in a moment. The font might be a little bit small because it's a longer email, or maybe our tech wizard can make it more visible. But we proactively reached out to everyone that we have an email for earlier this week, and the responses I got were a lot of gratitude that we were willing to be proactive, explain that Abra is fine, business as usual. We're not undergoing the issues that you've heard about from other folks in the space. We process deposits and withdrawals as quickly as possible. We pride ourselves in that. We use our own product. And so we, strongly believe that we should be treated no differently than users, and I can assure you we're not. And we want the same safety and soundness for our own funds. I mean, I have all of my liquid assets in crypto and cash. I mean, in Abra, and I want to know that as not only as CEO but as a large client that we're doing the right thing by my money. Okay, so I'm gonna. Hopefully you can go to the website and subscribe to the Abra email. So I do think we have a couple of questions you've answered. I've been reading the questions as they're coming in. How do we think about Lisa? How do we think about LTV as it relates to individual borrowers, as it relates to the overall position of Abra? Somebody was asking that in their own words, but it basically amounts to what does LTV mean for a lending model like Abra?
Right. So it's definitely one of the metrics that we look at, and but we also, the thing is that it's not a good leading indicator. So we are constantly trying to find out new ways, new metrics, to stay in front and proactive, right? This word has been uttered by us multiple times. But if you were to ask me, hey, describe Abra's risk management process in 2 words, proactive is definitely one, and prudent is the other. So yes, so that's
Wow, I love that.
leading.
I'm going to use that.
I'm going to use that.
This is not rehearsed, folks. So I am definitely using that. Well done. All right.
Yeah.
So I'm looking at some other questions. You've actually answered. There's a lot of questions here and a lot of comments, but I think they were you all on your own were addressing them, so which is great. I'll talk about CPERCs as everybody else wants to during the extended AAA session afterwards. But you've You've done a great job of answering the questions. Wow, it's awesome. Okay, so we've had this video posted as we do all the other videos. I hope you all will share it with friends that are curious about how all this works. We treat this like it was our own bank, because it is, and it's our own bank for our own crypto. And it's what I wanted for my own crypto, which is why we designed it the way we did. And, in the early days with the Abra management team, trying to figure out how to build all this stuff. And it's paying dividends for us now. We want to be here in 15 years as, honestly, I'll go on a limb and say, one of the largest banks in the world. And we'll have some announcements about what it means. And I keep using this phrase bank, and some legal implications of that, which I'm going to talk about in the coming weeks. And I'm really excited about it. I think if you're going to manage other folks' assets, crypto or cash or whatever, you've got to take a heavy-handed approach to doing the right thing, from a legal perspective, from a disclosure perspective, from a risk management perspective. And I really wanted two of the leading experts in the world, we're fortunate enough to have here at Abra, to give you their perspective on what's going on. So, Lisa, Justin, thank you so much for joining us, and we definitely want to have you back. This is a topic that I travel the world speaking, as you guys know, and when I bring up risk management, people are like, like this, and now all of a sudden everybody wants to talk about risk management. Go figure. So it's an interesting time.
Happy to come back.
Same here.
All right. Well, great. Thanks for joining, and we'll look forward to having you back soon.